So, last week we finished the microeconomics of banking, and starting today we are going to do more finance topics, starting with the derivatives and off-balance sheet banking. We have 4 preliminaries today. The first preliminary is about compounding method. So in week 3, when we studied basic bond prices and interest rates, we assumed annual compounding. So the compounding happened once a year. So if you borrow £1 million, and if the interest rate is 5%, and if the lending and borrowing contract is 1 year long, then after 1 year, the amount you should repay is the borrowed amount £1 million times 1 plus interest rate 5%. So that's £1.05 million. That was it. But that is when the compounding method is annual compounding, and there are many other compounding methods. The actual repayment amount will depends on compounding method. So if the compounding method is semi-annual, then after 1 year, you should repay 1 million times 1 plus the 5% interest rate divided by 2 squared. You have a square here because with semi-annual compounding, the compounding takes place twice in that year. And every time the applied rate is the annual rate 5% divided by 2. If it's monthly compounding, then this is the amount you should repay after 1 year. Compounding happens 12 times, and every time the applied rate is annual rate 5% divided by 12. Don't ask me why, it's just convention, tradition. There's no good mathematical reason for it. If it is a daily compounding, then after 1 year, you should repay £1 million times 1 plus 5% interest rate divided by 360 to the power 360s. You might wonder why it's not 365. Again, this is another convention. I guess in the past, the computer wasn't as good as nowadays, so 360 was, for people working in banking industry, 360 was more convenient number than 365. But anyway, the contract should specify what compounding method should be used, and if it's 360 or 365. If the lending and borrowing period is 3 months long, then with monthly compounding, after 3 months you should repay 1 million times 1 plus 5% divided by 12 to the power third, because the compounding happens 3 times in 3 months. With daily compounding, the exponent should be 90 because there are 90 days in 3 months. And that's compounding. For the exam of this module, just assume the annual compounding unless the question mentions otherwise. It's okay, right? Second preliminary is basic interest rates. Many economic models assume that there is a single interest rate R. But by now, you must have understood that in real life, there are many different interest rates because interest rate depends on who lends how much to whom, for how long, on what conditions. So the interest rate at which Barclays lends to NatWest can be very different from the interest rate at which NatWest lends to you. Today I want to introduce 3 famous interest rates: LIBOR, CD rate, and the prime rate. LIBOR is the acronym for London Interbank Offer Rate. Interbank is the market in which banks lend to and borrow from one another. So the interbank rate is the interest rate at which banks lend to and borrow from one another. So every morning, this institution called Intercontinental Exchange asks 16 major banks the following question. At what interest rate do you think you can borrow from other banks today if you want to borrow for 1 week? What about 2 weeks? If you want to borrow from some other banks today for 2 weeks, at what interest rate do you think you can borrow? And all these 16 banks, each of the banks answer, well, I guess for us to borrow for 2 weeks, maybe the annual interest rate will be around 0.5%, and each of these banks reports the answers. These 16 banks include Barclays, Royal Bank of Scotland, Lloyd, what else? Citibank, Bank of America, JP Morgan, BNP Paribas, UBS, Deutsche Bank, Tokyo Mitsubishi UFJ, HSBC, these banks, okay? And the institution orders these 16 reported numbers from the largest to the smallest, throw away the top 4 numbers, throw away the bottom 4 numbers, and take the average of 8 numbers in the middle, and that becomes LIBOR. So LIBOR is not exactly the interest rate at which some bank borrows from another bank, but it's a major indicator for that. In October 2013, the LIBOR for 1 week borrowing was 0.47% per year. The LIBOR for 1 year borrowing was 0.865%. LIBOR for 1 day borrowing is called SONIA, and it was 0.43% in October 2013. These are all annual rates, so if it's 6 months borrowing, you should divide by 2. Okay? Remember, all interest rates should be expressed as annual rate. Okay, that's LIBOR. CD rate is the interest rate offered by banks on certificates of deposit or time deposit. Your demand deposit with NatWest or Barclays, such as checking account or saving account, they are demand deposits. So you can withdraw your money anytime. There's no time to maturity. But if you deposit your money to these banks through certificates of deposit, then there's a certain time to maturity, such as 3 months or 6 months or 1 year, and you cannot withdraw before the maturity. And the bank can offer you a slightly better interest rate, than for demand deposit. And the interest rate is called CD rate. Okay? Of course, it depends on the time to maturity, 3 months, 6 months, 1 year. In October 2013, the 3-month CD rate was around 0.525%. Is it okay? Okay, prime rate. Prime rate for US banks is a reference rate posted by them for their prime customers. So the prime rate posted by Bank of America is the interest rate at which Bank of America lends to their prime customers, the best, most trustworthy companies, Coca-Cola, McDonald's, whatever. It also serves as a benchmark reference rate, so it's relevant not only for the prime customers but also for other borrowers, because actual contracts refer to this rate. Like, okay, you're not our prime customer, so the interest rate for you is our prime rate plus 2%, okay, or our prime rate plus 2.5%. So it serves as a benchmark rate. There's a similar concept for UK banks called base rate. Base rate is not necessarily for their prime customers, but it serves as a benchmark rate. So contracts say, okay, the interest rate for you is our base rate plus 4%, something like that. Okay, so LIBOR is the interest rate for lending and borrowing among banks CD rate is the interest rate for these banks to borrow from depositors. Prime rates are interest rates at which banks lend to corporations. Yeah? Okay, those were about interest rates. The next two preliminaries are for the study of derivatives and options. Preliminary 3 is option. Option in economics is a right to choose. Today I'm going to give you 4 examples of an option, and for your assignment you should give your own example. Okay, example 1. You look at a flat and you like it. However, you want to see another 2 flats before you make a final decision. You have a dilemma here. If you sign the contract today, if you don't sign the contract, then somebody else might take it. But if you sign the contract, you might regret if one of the other 2 flats turns out really good. So you have a dilemma, but no problem. Most of the time, landlords offer the following option. They say, okay, you pay half the monthly rent, and we will wait for you for 2 weeks. We will reserve the property for you for the next 2 weeks. So in this case, this half the rent is the price of the option for you to come back and sign the tenancy contract. Yep. Example 2. You will fly to Paris from London on the first day of next month. However, nowadays your health status has been a little unstable, and you fear that you might not feel well on the day of your trip, and you might cancel your trip. You have a couple of choices for this. Of course, you can buy a non-refundable ticket for £100. They might also sell a changeable ticket for £110. And in that case, £100 is the price of the flight, plane ticket, and the extra £10 is the price of the option for you to change your flight before departure. They might also sell a refundable ticket for £120. In that case, £100 is for the flight, and the extra £20 is the price of the option for you to cancel your trip before departure. So that if you cancel your flight before departure, £100 will be refunded. Does that make sense? Okay, third example. You are admitted to University K, which is your second preference, your second choice. You got an offer from University K. University K requests that you should pay the full tuition within 2 weeks, or the admission will be withdrawn. However, your first choice is actually University W, and University W will announce their admission result in 1 month period. Here you have another dilemma. If you don't pay the tuition to University K, and if you don't get admission from University W, you will have no place to go. However, paying the full tuition to University K seems like a very expensive insurance, because if you end up with going to University W, your first choice, you will end up with paying tuition to universities. I don't know what happens in European universities. I'm interested, so please let me know. But this is what typically happens in my country. So University K offers an option. They say, okay, you don't have to pay the full tuition now. Just to pay £1,000, and we will wait for you for a month and a half. We can reserve your place for 1.5 months. So in that case, this £1,000 is the price of the option for you to come back and pay the full tuition and get the studentship from University K. So far so good? Okay, last example. You are traveling to Sweden, so you want to buy some Swedish krona. The current exchange rate is 1 pound equal 9 krona for buying Swedish krona and 1 pound equal 11 krona for selling krona. You don't want to experience currency shortage in the middle of your trip, but you don't want to buy too much Swedish krona, because if you come back from your trip with a lot of unspent krona, you will have to buy back British pounds, and at that point, this bid-ask spread will become your cost. Even today, with 1 pound, you can buy only 9 krona, but to buy back British pound, you need 11 krona. Yes? You don't know how much you will spend during your trip, but no problem. Currency companies like American Express and Travelex offer you the following option. You pay extra 4 pounds, and we will buy back unspent Swedish krona for the same rate when you come back from your trip. And in that case, this 4 pounds is the price of the option to sell unspent Swedish krona for this pre-specified rate when you come back from your trip. Okay? So there must be many examples in the real life. You can even come up with some new idea of new product of option, and that's what you should do for your assignment. Okay, last preliminary, contingent claims. Contingent claims are financial claims, the payment of which is contingent on the future state of nature. Examples include insurance, bet, and derivative. Insurance is a piece of documentation which looks like this. This is an example of weather insurance. So it's a piece of paper, and the paper says, we will pay you £100,000 if the average temperature in Exeter in July 2017 is lower than 22 degrees Celsius. 1st of December 2016, and there is signature of the weather insurance company. A lot of businesses are subject to weather and climate risks, such as beverage companies, creameries, marine sports businesses, manufacturers of air conditioning system, or even farmers. So some of them might want to buy this type of insurance if the price is cheap. The payoff of this insurance depends on the future state of nature. In this example, the future state of nature on which the payment depends is temperature in July 2017. So this is an example of a contingent claim, in the sense that the payoff is uncertain. It will depend on the future state. Bet is another example of a contingent claim. So let's say Harry and Ron signed this piece of contract, and the contract says Harry must pay Ron £100 if Italy wins, and Ron must pay Harry if Ron must pay Harry £85 if Portugal wins. Their payoff depends on the future state of nature, which in this example is the outcome of some football match. The last example of contingent claim is a financial derivative. Financial derivatives are a contract whose payoff depends on prices or interest rates of some other financial assets. So that's why they are called financial derivatives, in the sense that these financial assets are derived from other financial assets. So for them, the state of nature is prices or interest rates of some other financial assets. This is an example of a call option. Again, it's a piece of paper that says if Mr. X requests, then Mr. Y should sell 1 unit of Vodafone stock for £5,000 on 31st of January 2017. And there is a signature of Mr. Y. For Mr. X, the benefit from this contract depends on the future state of nature, which is Vodafone's share price in January 2017. So it's another example of contingent claim. Okay? Now, for these things, it really helps, if you are new to finance and derivatives, it really helps to imagine a piece of paper or piece of documentation for these things, or for these options. It's really easy to imagine that a tangible physical objects such as a bottle of water or computers or desks have their price and they are traded in the market. But if you are new to finance, it's really hard to imagine that these contracts and options have their price and they are traded in the market. So if you are new to finance, just imagine a piece of paper, and this paper has some price, and the paper is contracted in the market. Okay? That's how you understand these options and contracts. These three things, I guess in economics, for economics theorists, these three things are not very different. I mean, insurance is, in a sense, it's a bet. Sometimes you make a bet to insure against something, and these financial institutions trade a lot of derivatives, sometimes for the insurance purpose, sometimes it's just a bet. So I guess for economists, these things are almost the same. Any question? Okay, there are two types of derivatives. Derivatives with two-sided obligation and derivatives with one-sided obligation. Derivatives with two-sided obligation includes forward contracts, futures, and swaps. This is an example of a forward contract. Again, it's a piece of documentation, and the contract says, on 1st of November 2017, Harry must pay Ron £10,000 and Ron must pay Harry 12,000 euros. And this is two-sided obligation because it is must both for Harry and for Ron. When they make this contract, the contract must be a fair bet, fair deal, so that neither person makes cash payment to the other at the point of contracting. Okay? It's a fair bet. At the point of signing the contract, it's a fair bet, so no one makes a cash payment to the other. But as time passes, exchange rate evolves. So as time passes, one side of the contract becomes the winner of the contract, the other person becomes the loser of the contract. So for example, if the exchange rate in November 2017 turns out to be £1 equal 1 pound equal 1.5 euros. Let's say the exchange rate in November 2017 is £1 equal 1.5 euros. Then Harry is the loser of this contract and Ron is the winner of this contract. Harry is the loser because without this contract, with his £10,000, he could get 15,000 euros in the market. But because he signed this contract, he can get only 12,000 euros for his £10,000. The Ron is the winner because without this contract, he would need 15,000 euros to get £10,000, but because he signed this contract, he only needs 12,000 euros. Okay? Right, so that's an example of a derivative with two-sided obligation. The state of nature on which the payment depends is, in this case, the price of the currencies. Derivatives with one-sided obligation are basically options. There are call options and put options. Call options are an option to buy something, and put options are an option to sell something. here we have an example of a call option. Again, imagine a piece of documentation, okay? And the paper says, if Mr. X requests, then Mr. Y should sell 1 unit of FTSE 100 index for £6,500 on 31st of May 2017. 1st of December 2016, and there's signature of Mr. Y. So if Mr. X buys this thing from Mr. Y, so Mr. X paid some fee to Mr. Y to buy this option. If Mr. X buys this option, it's option for Mr. X that is in May 2017. If Mr. X wants to, he can make a request and he can buy FTSE 100 index for £6,500. Are there any questions? Are you okay? Right. This is an option for Mr. X, but this is not an option for Mr. Y. This is obligation for Mr. Y. So if Mr. X requests, Mr. Y should sell 1 unit of FTSE 100 to Mr. X. Okay? Now you might wonder what I mean by buying and selling FTSE 100 index. You might think it's just a number. You cannot buy or sell index. You can imagine you can actually sell or buy FTSE 100. So if you buy a little bit of these 100 companies' shares to make a portfolio of FTSE 100 companies, that's FTSE 100. Okay? And the price, the value of such a portfolio is FTSE 100. Okay? So if FTSE 100 index in May 2017 turns out to be much higher than £6,500, let's say it's £7,000. Are you okay? Are you okay? Yeah. This slide or the previous slide? No, it's okay? Right. So if FTSE 100 turns out to be £7,000 in May 2017, then Mr. X can exercise this option. He pays £6,500, and Mr. Y delivers 1 unit of this portfolio to Mr. X, and if Mr. X wants to, he can immediately sell the portfolio in the market, getting £7,000. So his gain is the difference. £500 is his gain. That's called physical settlement. Mr. X pays £6,500 to Mr. Y, and Mr. Y delivers 1 unit of FTSE 100 to Mr. X. That's physical settlement. There's another settlement method called cash settlement. For cash settlement, if FTSE 100 in May 2017 is £7,000, Mr. Y simply pays the difference, £500, to Mr. X. No actual delivery of FTSE 100. Okay? And the contract should specify which settlement method should be used. Let's look into more details for derivatives, starting with derivatives with two-sided obligation. We'll look into forward contracts, futures, and swaps. Because this is the banking module, we will focus on forward contracts for lending and borrowing. So we do some basic math for forward interest rates and forward bond prices. Let's look at a simple numerical example. So let's say today is 1st of January 2016, and the lender and borrower enter into the following contract. The borrowing will start not today. The borrowing will start 1 year from today. That's 1st of January 2017. The borrowed amount is 0.9 pounds, and the borrowing will last for 2 years. So the repayment will take place on 1st of January 2019. The repayment amount is £1. Imagine that the borrower and the lender sign this contract today. What is the implied interest rate implied by this contract? What is the 1 year ahead, 2 year long forward interest rate, which we denote by R12, implied by this contract? It is 1 year ahead interest rate because when they sign, the borrowing doesn't start immediately. The borrowing will start 1 year from today. So that's 1 year ahead interest rate. It is 2 year long interest rate because the borrowing and lending will last for 2 years once it starts. The math is actually the same as the one we saw in week 3. The borrowed amount 0.9, by the way, if you think these numbers are too small, just put some million or billion and nothing changes for the math. So the borrowed amount 0.9 million pounds times 1 plus the unknown interest rate, which we denote by R12, squared, because this is a 2-year contract, equal to the repaid amount 1 million pounds. And if you solve for the interest rate, it's 5.41% per year. So the math is very familiar. We did this in week 3, but the interpretation is different. This interest rate is not applied today. It is applied in the future. That's the only difference. That's why this is called forward interest rate. Don't confuse this with future interest rate. We cannot predict the future. We don't know what interest rates will be, what the interest rate will be in the future. You know, no one can predict the future. But these interest rates, this interest rate is agreed upon today in the contract. Okay, so there's nothing uncertain about this interest rate. It will be applied in the future, but it is agreed upon today. Okay? Let us introduce some notations. So for this week, all interest rates have 2 subscripts. The first subscript indicates when the lending starts, and the second subscript represents how long the lending lasts. In week 3, all the interest rates were lending and borrowing that start immediately. Okay, those were spot lending and borrowing contracts. For interest rates, for such spot contracts, the first subscript is equal to 0 because the first subscript is when the lending starts, and for spot contracts, the lending will start immediately. The second subscript can be 1 year, 2 years, 3 years, 4 years, depending on how long the lending will last. And we had this term structure of interest rates. We studied that in week 3. For 1 year ahead forward rates, the first subscript is equal to 1 because the lending for these interest rates will start 1 year from today. Again, depending on how long the lending will last, the second subscript can be any number. Similar for the 2 year ahead forward rates, the first subscript is 2 because the lending will start 2 years from today. For 1 year long forward rates, the lending and borrowing will start at some point, and once it starts, it will last for exactly for 1 year. So the second subscript is equal to 1. Are you okay with these notations? Right. But all these interest rates are agreed upon today. Some interest rates will be applied in the future, but they are agreed upon today. So there's nothing uncertain about these things. All of these interest rates are known today. Now you might feel a little desperate because there are so many interest rates. in week 3, we had quite a few interest rates. We had this entire term structure of interest rates, and we had some a little complex math. Now we have even more interest rates. But no problem. As long as you know all the spot rates, the other forward rates are theoretically derived by spot rates. As long as you know all the spot rates, you can immediately know forward rates. So now let me explain that. Let's say you know all the spot rates. Spot rates are interest rates for lending and borrowing that start on the spot. Okay? So the first subscript is equal to 0. So all interest rates we saw in week 3 were spot rates. And suppose these are the current spot interest rates. For 1 year borrowing, it's 2.04%. For 5 year borrowing, the annual rate is 3.06%. Actually, these numbers are identical to what we saw in week 3. Okay? We are going to use the same numbers. Now, given that you know all the spot rates, what is the 2 year ahead, 2 year long interest rate R22 implied by these spot rates? Imagine that you want to lend your money for 4 years. There's more than one way to invest your money for 4 years. The simplest way is to lend your money through the 4-year spot contract, the interest rate for which is R04. Another way to invest your money for 4 years is to sign 2 different contracts today. So you sign 2 contracts today. One is the 2 year ahead, 2 year long forward contract, and the other is the 2 year long spot contract. So for the first 2 years, this is the interest rate. R02 is the interest rate applied. And as soon as this first contract ends, the second contract will become effective, and R22 will be the interest applied. Through the first method, your money will increase by a factor of 1 plus R04 to the power 4th. Okay? Through the first method, if you lend your money through the first method, your money will increase by this factor, 1 plus R04 to the power 4th. Through the second method, your money will increase first by a factor of 1 plus R02 squared. And then after that, your money will continue to increase by a factor of 1 plus R22 squared, this forward contract. Both methods have no uncertainty. All the interest rates are determined today. And therefore, these 2 methods should give you the same payoff, same return. Okay? Otherwise, there would be some strange arbitrage opportunity. So that's why we have equality here. We know the 2-year spot rate, that's 2.06%. We know the 4-year spot rate, that's 2.67%. The only interest rate we don't know is the 2 year ahead, 2 year long forward interest rate. So if we solve for this interest rate, it is equal to 3.28%. This is what I mean by forward rates should be implied by the other spot rates. Let's do one more exercise. What about the 3 year ahead, 1 year long interest rate? The forward interest rate that will be applied for the lending and borrowing, which will start 3 years from today and will last for 1 year. Again, think of 2 different methods to invest your money for 4 years. Method 1 is the same. Okay, just you invest your money for 4 years through this spot contract. Another method is to sign two contracts. One is the 3-year ahead, 1 year long forward contract. You sign it. And you also sign for the 3-year long spot contract. So for the first 3 years, your money will increase by this interest rate, and for the last year, your money will increase by this forward interest rate. So your money will increase through the first method. Your return is the same as before, 1 plus R04 to the power 4th. Through the second method, your money will increase by a factor of R1 plus R03 to the power 3rd times 1 plus R31. Again, these two methods should give you the same return, otherwise there would be some arbitrage opportunity. So we have this equality here. We know the 3-year rate, that's 2.45%. We know the 4-year spot rate, that's 2.67%. So if we solve for R31, the 3-year ahead, 1 year long interest rate is 3.33%. Okay? It's not very difficult. And in this way, as long as you know all the spot rates, you can compute all the other forward interest rates. So imagine you compute all 1 year long forward interest rates. For 1 year forward interest rates, the second subscript is equal to 1. So imagine you compute all of them. We already computed R31 in the previous slide. That was 3.33%. Imagine you do the same for all the other 1 year long forward interest rates. If you plot them, it's called forward yield curve. If you plot spot interest rates, it's called spot yield curve. That's the yield curve we studied in week 3. If you plot 1 year long forward interest rates, it's called forward yield curve. So in this diagram, the horizontal axis is when the lending ends. The vertical axis is the interest rate. So if we plot these spot rates, we get this blue curve, that's spot yield curve. If we derive 1 year long forward interest rates and plot them, we get this red line, and that's called forward yield curve. So in this example, the spot yield curve is moderately upward sloping. The corresponding forward yield curve is located above the spot yield curve. So far so good? Is it confusing? It's easy, right? Yeah. Okay, so let's study the relationship between the spot yield curve and the forward yield curve. The yield curve we studied in week 3. The spot yield curve can be, well, most of the time it's upward sloping, but sometimes it's flat, sometimes it's inverted, sometimes it's hump-shaped or U-shaped. If it's hump-shaped, then the corresponding forward yield curve can have a complex shape like this. There's a relationship between the forward yield curve and the spot yield curve. And to understand this relationship, we should understand that the spot interest rate is actually the average value, and the forward interest rate is actually the marginal value. Okay, let me explain this. This is a little tricky. Think about a 4-year spot interest rate. 4-year interest rate, 4-year spot interest rate is actually the geometric average, a sequence of 1 year long forward interest rates. Imagine again that you invest your money for 4 years. One way is to use the 4-year long spot contract for which the interest rate, for which your money will increase by a factor of 1 plus R04 to the power 4th. You can also assign a sequence of forward contracts, 4 1 year long forward contracts, and if you sign these 4 contracts, then your money will increase by first by 1 plus R01, and then by 1 plus R11, and then by 1 plus R21, and so on. And again, by no arbitrage argument, these two should give you the same return. That's why we have equality here. Now take the fourth root of both sides, and you can see that the 4-year spot rate plus 1 is the geometric average of the sequence of the 4 1-year-long forward rates. Does that make sense? That's what I mean by the forward rate, excuse me. That's what I mean by the spot rate being the geometric average of forward interest rates. Is this point clear? We can say the same thing for the 5-year spot rate. 5-year spot rate is actually the geometric average of the sequence of 5 1-year-long forward rates. If you compare the two, the only difference is this last term. The only difference between the 4-year spot rate and the 5-year spot rate is just this last bit, the forward rate at the last year. And this is what I mean by the forward rate being the marginal value. The only marginal change is this last forward rate. If the spot rate is the average value, and if the forward rate is the marginal value, we know the relation between the marginal curve and the average curve. You have studied that relation. You have seen this shape. Now, what does this shape remind you of? It's not a Greek letter phi. What is this shape? What is this shape? Where did you see this? Say it again? Yeah. In what context? Marginal and average cost. Thank you very much. Thank you. Okay, so you study that the average cost is decreasing when the marginal cost is below the average cost, and the average cost is increasing when the marginal cost is above the average cost. So the same thing can be said about these yield curves. Spot yield, spot interest rates are average values. So when the spot yield curve is increasing, the marginal values, forward yield curve is located above the spot yield curve and vice versa. This relationship between the marginal value and the average value is very general, right? Let's say there are 200 people in this room, and we all take a test. Okay, suppose the average mark is 60. Now, an additional student takes the same test, and suppose the average goes up to 60.1. What does this mean? It means that the mark of this marginal student was above the average, above 60. That's why the average went up. Yeah? If the average was 60, another student takes the test. Suppose the average goes down to 59.9, which means what? This means that the mark of this marginal student was below average. That's why the average dropped. Okay? So that when the marginal value is above the average goes up. When the marginal value is below the average goes down. The same thing can be said here. You know, I know that many of you have never done Excel before. So that's one aim of this assignment. I want you to learn as many Excel skills as possible. So don't start that just 1 week before the deadline. You will simply panic. Oh, I don't know any Excel things. Just start now, and you should learn this at least 20 things, like the absolute versus relative referencing, how to copy and paste equations, values, how to use functions, how to use solver, how to change the number of digits, how to make table, and so on. And there are many excellent tutorial videos for Excel made by lots of excellent instructors all over the world. So watch them, and try to learn Excel before you graduate, okay? Thank you.